I think something that we hear more so in this industry is exactly what you said, but from the mindset of attracting investors, and less so from the mindset of substantiating your track record and credibility to brokers and to lenders. And, some people take for granted lenders, less so brokers. I mean, but even still, some people take for granted brokers, which is your lifeline.
Yeah.
So would love to dig into that kind of stuff, because especially something really interesting, I think, is, and I was a new investor myself, very recently. And so I know exactly what it feels like to be a new investor. And a lot of new investors really get hung up on talking to brokers. It's the big thing they're nervous about. They don't want to say the wrong thing. They don't want to be found out as
right.
So I think it's so so interesting, and so getting your perspective will be great on that. And so I think that'll be a good conversation.
I mean, so brokers are obviously one group, and probably the biggest group of people who you want to feel like that you're doing all the right things, right? So that we talked about right before you hit board, marketing all of the successes you're having as investors, right? When you close on something, when you find something, when you're doing due diligence, like, advertising that stuff through social media, and so that your investors, your partners, your staff, all that can see that you're active is important, right? So brokers, one group. The lenders are, the good lenders that are involved. Good lenders are out seeking deals to buy as well for their customers, right? So a lot of, call it the average, lenders, they sit and wait for investors to come to them to ask them for debt. But the best lenders I've seen, the guys that do, crazy good volume, they're out calling brokers, they're out talking to sellers, they're out talking to customers they've done business with, and trying to drum up business, because if they can bring something to an investor, that is gold, right? And they're going to get a first shot at being able to finance that. Property managers are good folks to market to as an investor. I mean, think about how many properties are managed by property managers, and when their customer comes to them, and sort of says, "Hey, we're thinking about selling. We need, we need P&Ls, we need rent rolls, that's one of the first people they're talking to ahead of schedule, to be able to put together documents to hand to brokers and to kind of go through the process of whether or not they even want to sell, right? So they get a heads up. And if they're already managing something for you in Texas, and the guy they're managing for in Florida just called them up about selling, you can get a heads up that way. There's just appraisers, same thing. Like, these are all people who you want to be marketing and advertising to, mainly through social media, but also through mailings and phone calls and email blasts and things like that. Because the more activity they see, the more they think of you, right? Like, so when they hear about a apartment complex coming up, even if they don't own it, the only thing they think about is Rob, because that freaking Rob is all over the place. That son of a bitch sends me emails. I see him on social media every time I come on there. I see him speaking at some conference. I see him putting on some sort of webinar. I see him doing a podcast. He just closed on a deal last week. Like, all these things go together, and the human brain can't separate. They don't know if you own 200 units or 2,000 units, right? So marketing is a big thing that I think is super lacking in the investment world. And it makes sense. I mean, it's not like people who invest are naturally good at marketing, right? Like, that's a weird thing for people to be good at, is how to beat their chest, but doing it in a way that's not, it's not like boasty, if you will, right? There's a way to do it that's tasteful.
Yeah. And you can't resonate with everyone all the time, so some people's marketing style or personality style is going to rub some people the wrong way always. And so
yes,
you have to be okay with that as well. But yeah, I think that was great. And I think we've already got the juices flowing, so it doesn't make any sense for me to go all the way back to the beginning and say, all right, cut, now we're starting. So let's just keep it going. And I'm just going to say, thanks everybody for listening. As you can tell, we've just jumped right in. This is the Capital Spotlight podcast. Today we've got Beau Beery. I apologize if I said your name wrong, but
perfect, man. Perfect.
So Beau wrote a fantastic book that I'll let him kind of share a little bit about, and also just his background.
Cool. So I wrote a book back, and it came out in March, called Multifamily Investors Who Dominate. it's an inside look from a broker's perspective on the most elite investors in the world. These are the top 0.5% is what I've actually calculated in the northern half of Florida that I cover. And that same dynamic of scarcity of elite investors exists in any market. And I've basically taken 20 years of observing the best groups in the world, the guys who transact way more than everybody else per year, and kind of put on paper, in a 60-day, just kind of just let it spew out of my mouth on the paper, all of their methods on how they've grown tremendously, right? And so it's on Amazon in hardcover. It's on Audible, where I'm reading it with my energy and my insane voice. And then it's also on Kindle. My background is I'm a graduate of University of Florida. I did a marketing degree, went back to the master's degree. I started with Trammell Crow Residential, which was the largest apartment developer in the country back in the late 90s. I then went and worked for called the AMJ Group. They were big investors in multifamily, office, and retail, and I brokered and managed their assets. And then in 2010, I acquired a Coldwell Banker commercial and a Coldwell Banker franchise. My partners ran it. All I did was sell multifamily exclusively. And then I sold back my companies to my partners in 2020 and just kind of opened my own little boutique deal January 1st. It's just me and my staff members. And all I do is multifamily over 10 units, anything that's market rate or student housing. And I cover the northern half of Florida, which basically the southern border is like Orlando, Lakeland, Winter Haven, and I cover everything north.
So you don't go down to Tampa?
No, it's just not a market that I've ever lived in, been to, had friends in. It's a great market, but frankly, Orlando and Tampa are very institutional. And I know that, the REIT is not going to hire me. It's just, I can bang my head against the wall and maybe every 5 years I'll get a listing, or I could concentrate on, groups like you, which is from, call it the very, very large syndication down to, I don't want to say mom and pops because those don't even exist anymore in this business, but, the doctor who also owns 5 assets and he's trying to retire and he's damn near there. He's almost got enough cash flow. And so that's kind of my smallest guy.
So what I like what you said about your book is, if I'm not mistaken, you said you wrote in about 2 months, right?
Yeah.
And
it's getting it to Amazon that takes another 8 or 9 months, but the actual writing process, it's 20 years of pent up, everything I've ever wanted to tell an investor, everything I've seen that they've done wrong and done right, and wishing I could be like, hit pause and be like, dude, that was the dumbest thing you could ever say during the transaction, or the dumbest thing you could have done doing the walkthrough, or the dumbest thing you could have done just before closing. And I go back and I kind of write about all kinds of different stories and so forth on it's all about reputation and networking with brokers. That's how you get flooded with deals. The top buyers I see, they haven't gotten good at finding deals. They don't call sellers directly. What they've done is they become the type of investor that deals are flooded to them. When they walk into their office, they're not trying to make phone calls to figure out how to find their next deal. They already have like 15 deals in their emails and their voicemails directly from brokers before they've even listed it. And they're like, yo, Rob, this is Beau. Check it out, man. I got this deal that's coming up here. I'm going to be listing it in 2 weeks. It's going to be coming on the market, blah, blah, blah. Right. That's what the book is about.
Calls. Yep.
Yes.
So name of the game is getting more of those calls. And I think your book does a great job of giving a guide, and it's not an overnight fix, right? It's a long-term building of reputation, all that. And what I like about your book is, like you said, it's very inside baseball. You wrote it super quick because it was all the information was there. It didn't require any research because it's actually in the business doing deals. And I think my book is very similar. I wrote it similarly in about 2 months.
Yeah, your underwriting book. Yeah.
It was just really easy to write because it was just taking my structure and the way that we look at deals and just putting it on paper. And it might be right or wrong, but it's actually how we're doing business today. And so your book is actually how the best are doing business today as well. So that's really cool. And I think that's why.
And both books can be read 15 years from now, which is the good thing. And people can, it's still applicable today. That was one of my main things, is I wanted something that was the how to win friends and influence people. You're going to be able to read this 20 years from now ain't going to change. In fact, it's only going to be more solidified.
Agreed. And they're both nice and short. So I think they're absolute must reads. But anyway, so moving beyond the books, I think we've got some really interesting topics that are similar to your book, and I think we want to get to the point about marketing to brokers and really, you were stressing social media. Social media might be new to a lot of people. It's something that I kind of shied away from at first and have slowly been pushing myself to get more and more involved, recognizing the value. So it's really cool to see, from a broker's perspective, kind of share that advice as well, because I think a lot of people are intimidated by brokers and not really sure if they should be prim and proper or if they should be institutional or what have you.
Yeah. I mean, dude, it's like anything else. It's all about relationships, right? So, the elite investors I talk about in the book, if you can imagine, so in the book, I give step-by-step processes on how to build extreme relationships with brokers that last for the next 20, 30 years, right? And so if you can imagine, if an investor is, every 30 to 60 days calling every broker in the markets they cover, not just the successful ones, not just the 20 percenters, right? But the 80 percenters, the guy who does office and retail leasing, and then once every 2 years he gets a multifamily listing, right? Or or the guy who's a junior multifamily guy, whatever it is. Well, the problem is everyone calls the top 20 percenters, and there's a whole bunch of other guys who, if you add up all their transactions over a 5-year period, is a crap load of deals you could have gotten a hold of, right? And so, you're trying to basically just have the biggest funnel you can, because the guys who win big in this, they're not any better than anybody else. Underwriting is not rocket science, right? I mean, I seriously, I've said this before, I can teach my 16-year-old how to underwrite a $20 million asset in probably a week. It really ain't that hard. It ain't hard to manage managers. It ain't hard to figure out what construction costs are eventually. Now, there is a sixth sense to some of this stuff. I get that, and you get that over experience. But my point is, the hardest part about this business is getting deals to come to you, right? And so the guys who are the best at this business, the reason they're the best is because they see more deals than anybody else, and they see them before everybody else. And so just the statisticals of numbers says that the more at-bats you get, the more hits you're going to get, right? They may have the same percentage as you of winning them, okay, but they're going to have more at-bats. And frankly, most of them are actually getting better and better at winning a higher percentage as well, because of the way they do things. So, I've written about a bunch of do's and don'ts on how to build your reputation, but reputation is the big thing. That's what gets the callbacks to come over and over again. There's a lot of things that I see during transactions that are, just mind-boggling, and most of them have to do with either ego or just losing sight of the prize, right? So obvious ones are retrading, talking bad about properties, criticizing a price that a broker put out there, even though it's going to sell every single time. The way they act during a walkthrough in front of the seller's staff when the seller's not there, and they think that the seller's staff's not going to call the seller. I mean, come on. So there's all kinds of little things that, like, the problem is the person who's doing the wrong things oftentimes thinks he's doing the right things, and he's hearing this podcast and he's like, yeah, I don't do any of that stuff. And they do, right? Because there's an extreme minority of folks who are the ones we think of constantly as soon as we get a listing, right? So when I get a call from a seller and the seller's like, hey, Beau, we're thinking about listing our property. We want you to do a BOV. So I do my BOV. I come back to him. Okay, Beau, we like that price. And so before I've even created the marketing materials, before I've built the Dropbox with all the materials, I'm calling 10 guys right off the bat. Right. And I'm like, Rob, listen, so-and-so just called me. He owns the apartments over there in Daytona Beach off of Main Street. Yeah, those, the 122 units. I should be coming to market in about 2 weeks. I'm still finishing my marketing material. I'm doing all this stuff. You're still going to have to compete, but these guys are getting heads up. Right. And so that's why there's a dozen or more. I just did a video on this. I posted on social media. That's why there's a dozen offers in 10 days, is because the best of the best are getting calls ahead of time. So they're able to figure out what their renovation costs are going to be, because they're driving by the outside of the asset. They're already talking to their lenders. They're already talking to their leasing agents and property managers about what the rents are going to be. They're already doing runoffs on their pro forma, what they're going to sell it for in 5 years, right? It's a big advantage.
So yeah, I had a question prepared, but you already started answering it, which is, if it's going to be a competitive process, explain why it is helpful to see the deal early, and how can an investor, let's say you are one of those lucky few that does get that early call, how do we take advantage of that early call?
So one of the best things is you can already start asking questions in advance that other folks who come late to the game will probably never get the chance to ask, right? So you can already damn near fully underwrite it. You don't even need all the financials yet. You can already start working on rent comps and what the income portions can be. And you've already underwritten enough assets to know roughly what expenses per unit are going to be. And then when you get the real financials, when they come on the market, all you're doing is plugging it right in. But you can already start doing some of those things. And then depending on where you're coming out with the value, let's say it's a $15 million listing let's say you've got a heads up that's going to be around 15 million from the listing broker, and you're coming in around 13 million. You can still be calling the broker ahead of time and saying, hey, here's what I've assumed. Okay. Tell me where I'm a little bit wrong. Or, sometimes brokers, if they're sticking hard to to the guns, they may wait until it's actually on the market, but still you're already way ahead. And so once it's come to the market, then you can call the broker and say, hey, now that I have the real financials, I see here in the repairs and maintenance column, was this a one-time repair right here? Can you tell me a little bit more about this? Right. So in other words, day one that it's on the market, you're asking like super detailed questions that tightens up your pro forma and allows you to pay more than anybody else way before anybody ever even gets to it. Right. So that's probably the main big advantage that you've got right there. You've been able to eliminate more risk. And when someone can eliminate risk, they can pay more. Simple as that.
Right. So in our experience, there's rare, I'd say a rare, but we'll get your opinion. There might be a rare opportunity where the early look actually leads to your ability to preempt the process as well. And the deal never even goes to market because you presented a price that they like and they're willing to just transact. What is your opinion on that?
That's ideal for any investor. It's just super rare because what I have found is that any assets that are certainly over 50 units and oftentimes over 20 units, they're owned by pretty sophisticated people. These people know that they can list with Beau, and that in 2 weeks, Beau is going to have 15 offers, and then he's going to narrow those 15 down to 8, and he's going to have them all bid against each other. And he's going to get the price as high as possible, and it's going to be a big win. Versus, it's very rare that you have the mom and pop or let's say the guy who doesn't own a bunch of assets. He doesn't do this full time. He's not as sophisticated. Still, if he's working with a broker, that broker has a fiduciary responsibility still to earn him the highest. And that broker, if he's got any brains at all, isn't going to put his license in jeopardy to allow some way under market price to come in, because then he'll get sued. Right. So now it is still your best chance, yes, to get a better deal if you can get the sellers to agree to do a deal ahead of time. But oftentimes I have found that price is not really all that much less. If at all, it's usually more, right? Because again, these are sophisticated guys. And if you're requesting the right to not go to market, you're going to have to pay up. And oftentimes you're going to have to pay more, which is still, to me, I think it's still okay. Even if to be able to remove all competition and pay more than maybe that would have been, hey, if it still works in your number, what do you care?
You're removing a different type of risk.
A different type, yeah, it is. But I have found, I got to tell you, I have found, and you probably relate to this since you're really good on the number side. And I just did a video on this. You guys can see it on the channel, the Beau Multifamily YouTube channel. I have found that where the most deals get lost when there's bids going on is the buyers are just trying to offer just enough of a price to win instead of hitting an absolute home run, right? So here's my example. You get a $10 million listing and you're underwriting it, and your numbers, when you're looking at your numbers tell you, yeah, you can hit 10 million, but your numbers also tell you if this thing went to 11.8 million or 11.9 million, it ain't as big a profit, but it hits your hurdle rates. You can pay your investors. This thing looks good 5 years from now on the back end, but no one ever comes in at 11.8 and 11.9. They come in at 10, right? And the hope is that will get you in the best and final. And so let's assume it does. Now you're in the best and final. Then the same investors, and this happens almost across the board with everybody, the guidance from the broker is, hey, now that I've seen all the offers, you're gonna have to be at least 10.5 million to make this work, right? So what does everybody do? 10.6, 10.65, 10.7-ish, right? Even though the guy can pay 11.8, that's what he's doing. And so it's this garage sale mentality that it's almost like the investor can't live with himself, or he feels like his investors are going to be pissed, or whatever it is, that they would rather lose the deal than found out 60 days from now that the other guy who won the deal closed at a price that he would have well exceeded. So I've been coaching as much as possible, though I'm sure it will still always be a rarity, that you come in there and on the initial offer, yes, the initial offer has to be strong as hell, because the last thing you want to do is not even get into best and final. It's got to be strong. But on that best and final, I wouldn't be worrying about competition. Don't worry about competition. You come in there and you pay a price at which if someone pays more than you, you feel like they're an idiot. Like they must know something you don't, or they're stupid or something. Because in my mind, if you pay 11.8 on that $10 million deal, but it still meets your return, let's just say it barely meets your returns, it's a squeaker, whatever. 5 years from now, after you bought it for 11.8 and you sell it for 14 million or 15 million, you don't give a crap about that extra 800 grand or 700 grand, whatever it is. If it met your IRR, if it met your cash on cash and you're paying your investors, I guarantee you, your 50 investors 5 years from now were much happier to earn 16% than what you were hoping for at 21% at 10.4 million, right? That's the one killer I see over and over and over again. And I know it happens over and over again because every buyer on every multiple offer bid is, Beau, what do I got to pay? What gets me in there? What gets me the win? What gets me the win? Well, what gets you the win is absolutely just laying it on the table. The best thing that can happen for a buyer is when they turn in that offer, I get that offer in my email, I pull it up and I'm like, oh shit, this dude brought it, right? And I can't wait to forward it. So I forward it to my seller and I'm like, there's just all kinds of exclamation marks. I'm like, George, I'm like, dude, look at this. This dude killed it. Blah, 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 blah. And the seller emails me back. He's like, yeah, I think we got a winner. I can't imagine, right? And so I'm not saying pay more than you should or pay more than you should and it doesn't meet your returns and it gets you in trouble. That's not what I'm saying. All I'm saying is being true to your pro forma, that will win you more deals than just about anything on your multiple offer situation. But everyone's so garage sale cheap. And listen, I'm guilty of these things too when I go to buy stuff, right? If I'm at if I was truly at a garage sale, I want to find out, okay, if the guy's asking 50 cents, will he take 45, right? Or whatever. But this world is different in multifamily. There are hundreds of people who want that thing you're after. You can't ask what's the minimum you have to pay to win it. That ain't the right question.
Yeah, that's a really interesting point. And everyone's got their own strategy as far as how they come in on the bid relative to the pricing guidance, and then what their strategy is in best and final and all that. So that's really interesting to get that take.
Pricing guidance from a broker, what that really means is, hey, Rob, here's the minimum number at which I believe, based on what I'm seeing so far, will make you respectable, okay? That ain't the number that's going to win it, though. It's the number that's going to make you respectable because he doesn't know what the other best and finals are going to come in at, right? He's having that same conversation with 8 other guys. He's saying, I believe my guidance, I think you should be at least this much, right? Your job is how much above that can you swing? Like how crazy can you get above that and still be happy with the result? And the IRR, I keep talking about the IRR. The IRR is the big one here. I think that's the second big thing that wins a lot of deals is everyone gets so obsessed with the year zero returns. And year zero, meaning like when you buy it, what's, your cap rate,
Yeah.
It's horseshit. right? The IRR cures everything. If you plug in your pro forma an extra 500 grand on a $20 million deal, that IRR ain't adjusting much. It ain't changing much, right? Especially if you can tweak something else and it almost erases it, then you know it ain't much. This is a big numbers game, and people, it's, you know, losing the sight of the forest through the trees, right? They look at, they isolate that number, 500 grand. It's almost like 500 grand is stacked on a table, and you're looking at it like, yeah, that's a lot of money. But in the end, again, 5 years from now, when you're reaping what you sowed, 500 grand ain't nothing.
And, you know, even if your profits are slimmer, at least you have those profits to begin with. I mean, we've learned the hard way. We've lost out on wonderful deals that we would have loved to own qualitatively and for the, you know, return purposes, just because we were trying to get the best. We're deal junkies, and we want to see how good of a deal can we get. And so that is a very hard thing to you know, to adjust and change the strategy.
And here's why it's really, really important, Rob, because this business, the best of the best are the guys who get bigger and bigger and have more units, right? So, you know, in other words, you know, think of it from if brokers are controlling over 90% of all closings, which is a fact in the northern half of Florida, and it's going to be at least 70 or 80% anywhere else in the world. If the majority of those deals are being done by brokers, then you, I lost my train of thought. Oh, Jesus. What were you just saying, Rob?
Well, I was saying we've lost out on great deals because we just wanted to just pay enough so that we could get the best deal possible.
Yeah. So as a broker, you have to understand when you got a listing or you're in a multiple offer situation, whichever the case may be, you want to do business with a guy who owns the most units and has the biggest reputation for closing on the deal, right? And so the more and the faster you can pick up deals, meaning momentum, the more momentum you have, the sexier you are to everyone, brokers and sellers, right? And so listen, you know, doing the $11.8 million offer and just barely meeting your IRRs, still get your IRRs, still get your returns, still makes your investors happy, but it's also another feather in the cap that you can advertise around that you're a closer, that you're a big deal. All the brokers are seeing that stuff, right? And you close on another deal, right? And when you hand the broker and the seller in a multiple offer situation a list of your assets, it's another asset you can list that makes you look even better, right? You hear about the rich get richer. It's true. In my markets, okay, the top 1% of owners own 11% of the assets, and the top 5% own 27% of assets. And that number only gets more and more and more, especially right now, right? Especially in this world, that's what's happening is the mom and pop can't survive. The guy who doesn't own a lot of assets, who ain't out there buying and selling all the time, he ain't winning deals, okay? Unless he called the seller directly and that seller was, you know, naive enough that they never exposed us to the market. Maybe within a rush, maybe they were, you know, the husband or wife just died and they don't do real estate and they just caught them at the exact time. Maybe they do a deal like that. But in this world, almost everything's going to be, you know, taken to market or is owned by a sophisticated seller. You're going to have to compete against it.
Yeah, you might get one of those mom and pop deals, and it might truly be a wonderful deal where you do hit that 20% return, but you can't build a business around that. And that's the thing. It's a completely different story. So, you know, it's great when they come and it gets everybody very excited. But yeah, like I said, you can't base your business around it.
Yeah, so, especially from an efficiency standpoint. If like for instance, if you're like a 2-man crew or a 4-man crew, you know, you have to weigh out how much effort it takes to find that needle in the haystack, right? The widow or whatever that sells you the asset for below market price without exposing it to the market versus spending 4 people's times befriending brokers, appraisers, lenders, property managers, any referral source you can to bring you deals. That's where your time's better spent.
So on that note, so and you're talking about 2-man teams, 4-man teams, you know, and it obviously grows proportionally there, typically based on the, you know, firm size. So in your experience, out of all well, let's actually focus on the top 1% because that's who we want to emulate. So those shops, are the owners or the principals of the firm, are they the ones who are contacting you, the broker, or because they recognize the importance of the relationship, or is it the director of acquisitions who is tasked with that, hey, your number one job is to build these relationships? How do the
Right.
top 1% shops structure that?
It's a great question. So here's the thing. I've, like I said, I've been in this business for 20 years. I've watched this happen over and over again. The investment groups that are growing the fastest and adding the most number of units, are the ones in which the actual principals are the ones that brokers and other referral sources have access to directly. But what happens is eventually they grow to a big enough size where they become some of the bigger companies we know about today that now have acquisition teams, which are 2, 3, and 4 person groups that are, their ages are usually 25 to 40 years old. It's usually younger guys who are now the ones building relationships with brokers and so forth. That's good. But those bigger companies are typically not growing as fast percentage wise as the smaller to medium sized syndication. Now, I get it. As a big company, it doesn't make sense anymore for Principal Paul to be the one making all the phone calls and doing everything. I get it. They've made it, though. That's where you want to get. I mean, if you can have acquisition crews, that's fine. What I teach in the book is that those principals just need to teach the acquisition team how the game works, and teaching them reputation, and teaching them that brokers are the source for these deals, and how to operate in a transaction, and how to not mess up your reputation as a large company, right? So the elite investors were all small guys in the very beginning, and they were the ones who built the business, and the ones who maintained dominance and continued excellence has taught that theory, the theory of what's in my book, to all of their staff. So they all know that stuff, right? Now, there's a lot of groups who did it right growing up, got big, and then lost focus. And so a lot of their acquisition teams, they don't answer phone calls from brokers. They don't return phone calls. They don't move fast enough. They don't show up and tour the properties. There's a lot of things they don't do. And so yes, they've gotten up to 15,000 units, but they're pretty stagnant, right? They're doing like 1 or 2 deals a year or whatever. But the principles, like the elite investors in my book, the majority of them are between 2 and 10 people companies. That's it, right? But they're phenomenal at building relationships. And that's what this business is all about. I mean, you think about guys who over a 10, 15, 20-year period are calling brokers and lenders and appraisers and property managers every 30 to 60 days. And they're calling every single one on a regular basis. And, in the very beginning relationship, they talk about business. And then over time, over many, many years, you talk about relationships, and you talk about what you do on the weekend, and how's your family doing? Did your kid get into college there? And, how was the soccer match? And hey, what car did you just buy? And so it's like, you can imagine, I mean, even just over a 5-year period, developing that kind of relationship with 60 multifamily brokers, who gets thought of when a new listing comes to market. All right. It's not the guy who called me twice in a year and said, hey, do you have anything I can look at? It's the guy who's built a relationship with me. Right. And that's not a broker thing. That's just a human thing. Right. We want to do business with people who, number one, competent, but number two, people we like. It's really simple. And people who are, people are going to make you look good. I want to do deals with guys who make me look good, because that gets me more listings that I can then bring back to them and continue the loop cycle.
Yeah, absolutely. So let's go to a fun topic, which is, especially with new investors, they are often, out of everything that there's to do in this business, which there's a lot, I think it seems like new investors are most intimidated by talking to brokers and building relationships, because they, like we said, they don't want to be found out, or they don't want to say the wrong thing and not get the deal. And so is your advice for somebody who's on the newer side, and they don't own any property in that particular market, or they don't own any property at all? How should they conduct themselves, and what should their pitch be to the broker?
So so a new person who owns nothing, they're new in the business, they're not going to like what I have to say, but I've said this on other podcasts and it's just the truth. I'm going to give you the hard truth. You cannot make it in this business by yourself. It's not going to happen. I mean, why would I bring you a deal when you own nothing? And I know 45 guys who each own at least several hundred units. They're going to close on this thing in 30 to 60 days. Why would I put my reputation on the line with you? It's not going to happen, at least not on a regular basis. The best thing the new person can do is hook up with someone like you, Rob. I mean, it is to basically get with an investment company, a syndication, a partner, someone who's got, a list of assets, whether it's just 3 or 4 properties or whatever you can get a hold of, and has experience and has recommendation letters from brokers and has access to capital and equity and all that stuff. Someone who, when you submit your bio package to me, you've got you and you've got Rob on there. And Rob and I are teaming up and we're buying this. And our company that we own together owns 800 units and 400 over in Texas and 200 over in Florida. And so that's how a new person wins deals. Now, listen, in the call it under 20 unit or more so under 10 unit world, it's a different world, right? Because the quadruplexes, duplexes, eightplexes, those are mostly controlled by a residential realtor, right? Someone who sells houses. Those people get more of those types of listings than a multifamily broker, because a multifamily broker, at least one who's worth a grain of salt, doesn't really do much under 10 units because it's not financially feasible, right? So in that world, a new person, if you don't want to go straight to 10 plus units and just build a portfolio of duplexes to eightplexes, yes, you can develop a much faster reputation with residential realtors. I still think even in the under 10 unit world, you have a far greater chance of whipping everybody's butts in the competition to link up with a Rob. Because if you can be with a Rob and you're buying quadruplexes and you can show that you own 1,000 units, like, holy crap, you're gonna clean up, right? So you got to find these people, and there's plenty of them out there, right? I mean, there's plenty of these gurus now that have legit systems in place to bring on people. If you can get good at finding assets, there is plenty of money out there if you don't have a dime in your pocket.
Love that. Yeah, and I agree. That's one of the things that I really appreciate about the real estate business is it's very partnership driven. And also the way I look at real estate also is these deals, it's kind of like dating. You don't have to partner and now all of a sudden it's a marriage and you're in it forever. You could try a deal out and you can do a deal together and you can say, oh, that actually wasn't the best deal or it wasn't the smoothest process. And, you don't have to do another deal. So it's cool that real estate is that way. You have that one-off opportunity, so to speak. So I think that is conducive for the new.
Right. I mean, listen, operating agreement, there's plenty of really good operating agreements out there that spell out every worst case scenario that's ever happened, that you can usually get from attorneys that can create a partnership with someone. And listen, new people, yes, you may have to give up, 90+% of all profits or the vast majority of all profits for your first several deals that you do with partners. But you have to understand you're learning the game. Like that's a college education or a PhD that you're earning so that you can eventually do deals, by yourself. Because why would any legit investor, give you a bunch of, 20 or 30% free equity for nothing, just finding the deal? Finding the deal is powerful. Trust me, that's valuable, but you also have to bring in perspective. That partner has far more experience than you. There's a whole lot of things that can go wrong in a deal, and you need him to keep you right.
The thing that I tell a lot of people is, it's very, very, very unlikely that you'll be able to bring me a deal that I couldn't myself find that is roughly equivalent, right? Let's just say my return hurdle is 14% IRR. Mm-hmm. If you bring me a 14% IRR, I can probably find my own 14% IRR. And therefore, the reason to partner with you is not so attractive because why would I, like you said, maybe I get 80 or 60, 70% of that deal. Well, I could just get 100% of the 14. So you have to, in effect, if you're looking to partner with somebody and your value to the partnership is the deal, which like you said is hugely important, it better be a 16, 17, so that the pie is bigger, so that it's more attractive for someone to go, gosh, I really like doing my own deals. but wow, cause like I said, we're all deal
Sure.
junkies. You can't turn away a hot deal. You'll give up a piece of the pie to get into it.
That's right. Yep.
Well, good stuff. Well, I thought this was a great conversation. Love to have you on the show. And I definitely recommend everybody listening to check out your book if they
Thanks,
haven't
Aaron.
already. So let's, hope for more sales and maybe another book. I know I'm working on my next one. So good stuff.
Yeah, I'm gonna do one for brokers, and I need a couple years to rest. Honestly, the worst part, maybe the writing is easy. It's going through the Amazon process was absolutely hellacious. Like it is a really difficult process. And next time I'm just going to hire a group that does it all. They do the editing, the proofreading, the artwork, the everything. They deal with Amazon, all that stuff. That's what I'll do next time.
Absolutely. And it's cool that you did an audiobook. That's something that I need to step my game up on. That's
I
cool.
tell you, on my sales, I track it. It is, let me tell you real quick, just for your own knowledge. Luckily, I did some poll work on LinkedIn ahead of time. And let's see, my book, sales tracking. So 51% is hardcover, 31% is audible, and 18% is Kindle.
I'm surprised.
I was too, but I did that poll. I did a poll on LinkedIn before the book came out, and I was deciding whether or not to do audio. And I put out, and everyone I'm connected to on LinkedIn is a real estate person, so that was good. It was a good indication. I put out there, and almost those same stats came back, and I'm like, well, shit, I got to do a recording. Like, I got to, and I'm glad I did it. I mean, 30% is a lot, dude. Like that's actually, I mean, half of it is Kindle and audio.
Right. Absolutely.
And I thought it was important for myself to read it too. I didn't want someone else who's, not in the real estate business that they wouldn't know when to raise their voice and lower their voice and drive home a point or whatever. So, yeah.
Yep. And from the author's perspective, obviously having someone listen to your voice, they feel like they get to know you better. So
yeah,
that's a big plus, I think.
Great point. By the way, if you do an audible on the next one, Rob, one thing you're not going to believe is it is exhausting. I mean, it's like an 8 or 10 hour day, and you're sitting in one chair, and you take lots of breaks, but to speak correctly and you're reading, and you have to follow everything perfect, and every word has to be read exactly. And then there's a guy in another room with a headset on, listening to every word and everything that you're saying, and he stops you in order to have you redo a sentence. And it's like, I mean, I actually got lightheaded, like I was going to pass out by like hour 6, because you're just winded and you're tired and you're not able to eat as much, and you're drinking constantly in order to to get your. It was freaking exhausting. I couldn't believe it.
Wow. So you did it legit. It sounds like, in the studio and.
Oh yeah. The full thing. Absolutely. Yeah.
Cool. Well, thanks again for being on the show.
Yeah, dude.
And I'll talk to you soon.